Hi there, it is Corey here, CEO and founder of Verse Wealth. And today I'm joined once again by Tom Schubert, one of the managing partners at Drummond Capital Partners. Tom is here to give us some insights into what's been happening on investment markets over the course of 2023, what's been happening in the US economy, our economy, interest rates, inflation, recession, soft landings, hard landings. There's plenty of ground that we are going to cover. And Tom, thank you for joining us so we can cover it together.
Thanks for having me, Corey. Great to be back.
Good to have you here. Now let's dive in, Tom. So first things first, just broadly with investment markets, I think 2023 has been a surprise for most in terms of the returns that equity markets have delivered. And when I say equity markets, largely the US. So the S&P 500, the mainstay of US indexes, is up 15-16% for the year. As of today, the Nasdaq, so the tech market, which took a significant battering in 2022, is up 31% for the year. We know big tech has led a lot of those gains. More broadly back home, the All Ordinaries, so our top 500, is up roughly 5% for the year. So tell us more broadly what's been happening on markets thus far this year, but in particular, direct your attention to the US and why they have outperformed and why that matters for us, given the US economy and US markets tend to have flow-on effects to us and others.
Yeah, great observations, Corey. So sort of stepping through this year, as you rightly said, 2022 was a bit of a write-off for a lot of equity markets around the world. And January this year was a big month. Markets were up about 6 as China reopened, and the US actually had made a bit of a recovery from its Q4 slump. And so we did see broad strength around the world in January this year. And then since then, somewhat of a decoupling. I think Australia's largely flat since the January spike. And so all of that return was really from that month. Whereas then we had the AI boom. We all became familiar with ChatGPT. And all had a go at that, and then investors went looking for the stocks that were going to be the beneficiaries from this technology. And in this, at least over the last 6 months or 7 months, it's been all driven by the Magnificent Seven. There's always a different term that's coined for these large cap companies, but these are the Microsofts and Googles and Nvidias of the world that will have benefits from an earnings perspective from AI and the adoption of that technology. And so, as you pointed out, it's been the tech index, which has really carried the US market much higher. And it's actually at the expense of yet to be earnings. So it's all been valuation driven on expectation of those AI earnings coming in the future. In fact, year to date, earnings for the US market are down almost 7%, which we've had weak earnings. And despite that, we've seen stock prices in those big companies continue to rise. Partly, they were a bit oversold in the late part of last year, and secondly, the perception of benefiting from AI. And because of the size of those companies, that's dragged the whole US market higher. And in turn, given that the US represents 70% of the global equity market, it has dragged the whole global equity index higher with it as well. So they're incredibly powerful in terms of their force and impact on global equity markets.
That's a good point, given we've got these Magnificent Seven as you're describing them, and their performance is having a significant effect on the overall numbers of the market, but it doesn't kind of tell the whole story, because if you've got 500 stocks and 7 have done incredibly well, maybe the other 493 aren't up nearly as fast. So just to put some numbers around that, like with those 7, or picking out an Apple or an Amazon or so on, how large are these companies relative to the rest of their market? And maybe how large is, say, an Apple relative to the Australian market?
So Apple itself is bigger than the whole Australian market. I think those 7 stocks alone now in terms of market cap are bigger than the UK, Germany, and a couple of other European markets added in together. These are big companies. And so at a sector level, if we look at the makeup of the global equity market, so in the US, it's a much bigger proportion, but they're sort of 45% of the index. So you really got to pay homage to what's happening in that sector and how much it can influence the whole performance of the broad market, if that makes sense. So yeah, very big companies by value. And so very small percentage changes even in their value has has a still significant impact on the whole market.
Yeah, well said. I mean, it's frightening to think that some of those individual companies have a market cap. So the value of that company is worth more than every company listed on our stock exchange. And there's more than about 2,300 these days. So as you said, one company can move the needle a long way in terms of market returns these days. So staying on the US, so we've just been talking a bit about, the big tech companies, broader market returns, shifting gears a little bit more to the US economy, because I'm sure in some way market returns in the US this year have been supported by the economic data coming out of the US. I think that they have surprised to the upside in terms of inflation data in particular. So if we went back 12 months ago, they had inflation peaking at 8-9%, whereas now they've got inflation around 3.2%. That's almost within what would be the RBA target band of 2 to 3%. They may be nearing the top or at the top of their interest rate hiking cycle as well, and they've maintained record low unemployment, even though they've had an intentional slowing of GDP growth with the rising interest rates. So maybe just talk more broadly about the US, your perspectives on it, what maybe has surprised you and where you think they might be headed from here.
Sure. So the US economy has performed very well, and there's really, as a function of a couple of key points, I think the strength of the private sector in the US is it's such a capitalist-driven, growth-orientated entrepreneurial economy. So it always surprises, I think, that strength, and so that's something to note. But then in turn, both the household went in with really strong balance sheets, so they had their GFC and deleveraged a lot post the GFC. So consumers went in a good position. The fiscal handouts, the savings that accumulated through COVID, meant that despite rates rising, they continued to spend. They've had full employment, as you pointed out, and so the strength of the US consumer has been quite remarkable. Secondly, on that point, I guess, is that most of the US mortgages are 30 years fixed, and a lot of people refinance back when rates were really low, and so to the extent that their central banks hiked the cash rate, the Fed funds rate, there hasn't had the same impact on household finances as it would in Australia, where we are a floating rate economy, and the effect of that higher cash rate has a more immediate impact. So consumers been strong for a couple of reasons. And then the private sector as well, similarly, took advantage of terming out and setting their debt profile at low interest rates. They had accumulated savings. The corporate sector was in good shape, and so they've continued to spend and invest, and that's kept the US growth engine kind of humming at a reasonable clip. And look, surprisingly, the rate hikes to date have managed to slow the economy down. So we see it in the growth rates. Growth rates have come a long way back down from where they were in 21. They were quite sluggish through a couple of quarters, at a negative quarter last year. They managed to come back. So they've done a really good job of taking the heat out of the economic growth engine, which has in turn brought inflation down. So it's managed to temper inflation without actually thus far tipping the economy over into a recession. And so, that I guess highlights the relative resilience. And again, while, in some ways the equity market is where it is because it hasn't, the sort of the hard landing or recessionary style scenario hasn't eventuated at this stage.
Well, yeah, I mean, on that point, and it's something I think I've heard you mention in recent times, is like the US Fed. So their central bank, that's their version of the Reserve Bank of Australia. They've kind of seemingly threaded the needle in terms of how they've managed the interest rate hiking cycle without having the flow-on downstream effects to the economy where things slow down faster than they anticipate, unemployment spikes up higher or faster than they want. So credit to them thus far. In terms of recession, so probably a good segue into this conversation about soft landings, hard landings, and no, we're not talking about air traffic control here. We're talking about economies. So firstly, can you explain what is a soft landing, Tom? What is a hard landing? And maybe just give us a bit more detail around, is there a soft landing coming in the US? Is this a soft landing? Could there still be a recession? And what are your thoughts along similar lines back home here in Australia?
Sure. So the soft landing is probably what everyone is focused on at the moment, and it's indicative, I guess, of the current conditions. So the economy slowed down sufficiently to get inflation under control. So they've done just enough on the interest rate hiking cycle without causing a recession and a big spike in unemployment. And so that is the soft landing. We've somehow managed to go, okay, big rate hiking cycle, cool the economy, slow it down enough without tipping it over completely. And I think that's where market pricing sits at the moment from an interest rate perspective. So it looks like all the market pricing says that we're now at roughly at the top of the rate hiking cycle. So and the growth's okay, and the employment market, as you mentioned, is still okay. So that's a soft landing. Hard landing would be the recession, and that is the pace and an actual magnitude of rate hikes, which is over 5% in the US in short order, eventually does tip the economy into a recession, which means unemployment rises. We see defaults in credit, etc. Small businesses, bigger businesses start to default on their debts, etc., and you create a credit cycle. So that's a recession and a hard landing. That's not good for equity markets. Under that scenario, soft landing is great. Earnings hold up. We don't see the default cycle. We muddle through and then off to the next sort of growth path. Recession means you're getting downgrades, losses, and earnings coming, negative earnings coming through, I guess. And so where we are, certainly given the performance lately and the data, there is we think it's about a third chance of a soft landing, which is, that's reasonable, right? And a lot of the recession pricing is potentially just being pushed out. So we may, recessions are inevitable, but it's more that maybe it's been pushed out. But I think one of the things to note is just a lot of it takes time for all of the rate hikes to be pushed through the economy. So there's often a lagged effect. And so given things I spoke about with the US consumer, they haven't really felt the full impact of rate hikes, similar with the corporates. So to the extent that rates stay here for a lot longer, potentially as we go into next year, they start to feel more meaningfully the impact of those hikes. And I think if you look at the Australian example, as you asked before, look at Australian retail sales, look at the activity and what's happening to home builders. So in Australia, we're feeling a lot more the pinch of those rate hikes which were put through last year. In some ways, the US is not going to feel those until we roll into next year. So there is some delayed impact. But having said that, Australia continues to slow down. But again, we're not in recession. Like there's not. It's you'd argue it's still a soft landing, but it's hard to see what the catalyst to kind of get us out of the slump will be absent rate cuts. So what we really need to ensure a soft landing is a really successful landing, if you will, on inflation everywhere. So the trend is certainly in our favour at the moment. So inflation back down to 3, if we get it into that sort of 2 to 3 band, that's going to give central banks the ability to actually maybe pull back a little bit, ease policy as required, so that the soft landing doesn't go all the way into the recession. So we're on the path, and we think that's why the probability of a soft landing's gone up, but it is still delicately poised. And if inflation keeps going, that's good. If it doesn't, if it reaccelerates, if the services sector like wage growth, etc., continues to remain sticky, or we see commodity prices start to spike again, causing some of that inflation to come back, that makes it harder for central banks to cut. They'll have to sort of persist. And so that's really the key for us, is to watch over the coming months and make sure that trend in inflation continues down. And then that's going to give us some more confidence that the central bank should be able to help, stimulate the economy and engineer that soft landing.
Yeah, well explained. There's plenty there. Just diving a bit deeper on interest rates, because I know for Australians broadly, clients adverse, plenty of Aussies had locked in fixed rates, on their mortgage, perhaps investment debt as well, at between 2 and 3 or low 3s, mid 3s in recent years, and they might have been locked in for 2, 3, 4, 5 years. They're coming off those fixed rate periods now. They have, or they will soon. The fixed rate cliff, it's been referred to as, and there's still plenty of people still to come off that fixed rate cliff in the next 6 to 12 months. So the flow-on effects will be felt to consumer spending and and so on, because what could have been a surplus household cash flow that looks like this post moving from fixed to variable rates might somehow look like this, and there's flow-on effects to how people spend and so on. So with that in mind, and thinking about mortgage holders listening to this, is it your view that we probably have reached the top of the rate hiking cycle here? Like you've mentioned a few times, we've got a cash rate of 4.1%. Westpac, looking at their forecast this morning, they're not recommending that we see any more hikes. Is that your view? And what do you see as, I guess, the probabilities of maybe getting some relief in terms of that variable rate, in at some stage in 2024, whereby rates, do perhaps move downward?
Yeah, I think, we're at the peak, it would seem, given we can see the impacts. I mean, we've had very weak retail data now for some time. We are starting to see a little more supply come on, particularly in fringe areas or holiday homes, etc. And I think one of the things that's, there's a nice window open in terms of, because we've opened up to immigration again, and there's not a supply and demand imbalance in Australian housing, that we're not seeing a more meaningful decline in values. And I think that's a good thing. So the asset, liability side of the equation is okay. To your point, it's really around that serviceability buffer and how much people can afford to continue to service, but you're not sort of looking at a negative equity situation. And so I think a lot of people, when you can see it now in the types of supply that's coming onto the market, are thinking about, well, maybe if I've got a bit much debt, I'll go and sell an investment property or the holiday home and deleverage to try and get that income side of the equation under control. And given values are holding up, that's actually affording people the opportunity to do that. So that's a real positive, I think, in our ability to get through, as you say, this reset from low rates to high rates. And given the borders are open and the supply demand side, that looks likely to sort of hold, hopefully, and that's a positive. In terms of rate cuts, again, I think it comes back to that inflation question. So we are actually going to transition through Philip Lowe, the current RBA governor, is on the way out. Jim Chalmers has engineered a review of the Reserve Bank earlier in the year, and they're separating. They're now going to have two committees, one for governance, one for interest rates. We haven't quite seen who's going to be there exactly in terms of making the decision on rates. And so it's kind of a little bit hard to judge whether they're going to be hawkish on inflation or whether they're more likely to want to come in and actually stimulate what's pretty subdued economic activity in Australia. But we do need, the fiscal side to slow down. I think, there's a lot of spending still going on in governments around the country. It's indicative of a broadly Labor, nation at the moment. And so that spending is actually keeping inflation sticky. It's good long-term in terms of new bridges and trains, etc., but it does actually keep wages growth going through the economy. And so to the extent that the fiscal side stays on, the RBA will probably have to stay on hold. If we do see some moderation in the fiscal spending side, that's probably going to give them the chance maybe to ease a little bit going into next year if inflation's under control.
Yeah. Okay. So long story short, it's all about inflation, fiscal spending. If that was to slow down, that's going to be helpful. There is the prospect of rates coming off next year, but again, it all just circles back to inflation and whether we can get that to that meaningful 2 to 3% band that the RBA is and has been and is always targeting.
Exactly.
Yeah. Okay. Last question for you. Conscious that we've taken up a bit of time here. If we just go back to investment markets, investment returns, we're talking before about the US market, having done really well this year, led by, big tech companies. Our markets put on a small amount of gains, largely from January. What if you've had a portfolio where you've been more defensively positioned over the course of the year? The prospect of recessions and earnings downgrades and volatility and so on has led you to think, hang on, actually, I don't want to be overly aggressive with my portfolio at this point in time. I want to hold some more cash. I want to hold some more defensive assets like bonds. How are those aspects of the portfolio typically holding up, and what kind of returns have they been providing investors?
Yeah, sure. It's from a portfolio construction perspective, we're now sort of back to, I would say, a more normal environment. So we recently completed our sort of long-term strategic asset allocation review, and that's where we reset and look at the optimal mix of assets for those given risk profiles and how to generate the sort of best long-term risk-adjusted returns. And pleasingly for investors of all risk profiles, the long-term expected returns have gone up, and partly that is a function of higher returns from the defensive part of your portfolio. So those years where the only way to get a return was through capital growth, portfolios of all risk profiles are now able to be blended with an underpinning of risk-free or near risk-free style returns. And so when we look at what we hold, you mentioned the RBA cash rate is 4.1, but we step through various parts of the defensive balance, defensive assets and government bonds. We're sort of in the 4 to 4.5% range. So they're giving us good coupon as well as providing some defensive characteristics. We go into investment grade corporate bonds. So this is lending to like the highest quality corporates on the ASX 200, the banks, Woolworths, Telstra, etc. That don't default, that always pay their debts. We're getting 6% coupons now paid, monthly, quarterly out of those types of assets. That's pretty attractive, right? So, and then as we look, even down into the slightly more risky corporate lending, space, we're now up into the high single digits. So you're able to sort of blend what we say those defensive or income style assets together now to actually get you a pretty nice return as a baseline within a portfolio. So that if you do go through periods, even looking at the ASX this year, you've been flat since February, that defensive side is there giving you a nice coupon, along the way, waiting for that next leg of growth, because equity markets don't go up in a straight line. Similarly in the US, we're now sort of this month down a couple of %, might muddle along and consolidate some of those recent gains. Again, having that anchor of fixed income within portfolios just keeps the return profile, sort of chugging along. So we think for all investors, but particularly those that are more defensively orientated, it's a much better place to be now than it was 18 months ago.
Yeah, and for some time while we've been in this lower for longer interest rate environment, I think back to when I first started advising, 12, 13 years ago, and you could put pre-retirees and retirees in term deposits at, 6.5%, 7%, and they could get great returns and great income from defensive assets that didn't have the risk, where they might not want to take on a significant level of risk as well. And we're moving back into a more balanced and more traditional environment where you can get returns from all different asset classes. You don't need to just be heavily focused and concentrated, in the share market, in equity. So good for plenty, in particular those that need plenty of income that maybe not working, maybe in retirement. So that's a welcome change for them, I'm sure, after plenty of years of of needing to get all their returns from equities as well. So as I said, we've covered plenty of ground, Tom, as we normally do when we've got you once a quarter. We appreciate your time and your knowledge as always. Thanks for sharing. It's been great to see you, and we shall see you soon enough.
Thanks, Corey. Good to see you.